about taxes, all things taxes. As you know, tax season is right around the corner, and we want to ensure that that we are all prepared. So for this session, we encourage you all to please put any questions in the chat that you may have. This session is being recorded and will be loaded if on our YouTube channel if you need to go back and um, rewatch it again. But yeah, I will hand it over to Moses to introduce himself, and we'll go from there.
Awesome. Thanks, Tashi. So my name is Moses Dakwa, and I have been a CPA for the past 9 years. I have my own firm where I help clients with both accounting, bookkeeping, and tax-related matters. I also do some consulting for some big clients as well. So that is basically my background. I've been working on taxes basically all these years, and so I believe I'll be a good resource for us today as we walk through some of the new updates here for our 2025 tax period, and also as business owners, pick up some good tax planning tips that we can adopt as we near the tax season for 2026. So without wasting my time, I'll just move on to the next slide. And as Tashi indicated, if you have any questions, you can drop it in the chat. Also, there'll be some time at the end of the slides to also ask for request for questions from folks here on the call. Okay. So our content for today, screen. Let me know if you guys can see it. See my screen?
Yeah, we can see it.
Perfect. Awesome. So yeah,
I can see it.
Awesome. Thank you. Okay, so the table of content for today, we'll be looking at 5 main items. The first item we'll be looking at is the business structures and tax filings. Additionally, we'll also be looking at organizing business records as small business owners or small to medium-sized business owners prep for the tax seasons. We'll also look at understanding some deductions as business owners, and also some mistakes that we typically do that we want to highlight so we can avoid, at least for this tax season. And then finally, we can delve into what the OBBBA Act stipulates, which forms the basis of what I need in 2025. This will be a helpful resource for you as you prep for 25 tax seasons. Okay, so jumping in business structures, and again, it's more of a refresher. Once you set up your business, I believe you should be able to identify the type of business you are operating, and then the patients. So typically, most businesses in the US fall into these 3 broad categories: unincorporated businesses, LLCs as the second one, limited liability companies, and then you have the final one, which are called the incorporated businesses, which is basically your S corps and your C corps. So the first bucket talks about businesses that hasn't registered with their states, Secretary of States. So you have maybe a mom and pop shop that just got a location. Maybe it's a market, like for example, an African market, selling their products to customers who come in, a retail business selling products. They haven't registered a business at all with the Secretary of State. You could have a situation whereby it's just a one person or one owner business, or maybe multiple own businesses, multiple member businesses, which would form a partnership. So you can have both sole proprietorship and a partnership that hasn't registered yet, and that will fall under the unincorporated business. Such businesses have unlimited liability, which simply means that any legal suit, if maybe someone comes to your premises, gets injured, they can sue you. They can sue the business, and then extend to your own private assets. So, in other words, if somebody comes to your office, slips, breaks their leg, and they take you to court, and whatever claims they get from the courts, and your business assets cannot make up those claims, the suit can extend to your private assets. So maybe your homes or whatever money is in your bank account. And that's the risk of you not registering your business with the Secretary of State. Now, said businesses, both sole proprietor and partnership, have what we call a pass-through filing, where itself doesn't pay income tax. The profit and loss of the business flows through to the owners of the business. And that is what we call a pass-through filing. Said businesses pay self-employment tax of 15.3%, and distributions out of those businesses are free. They are tax-free. So that is for unincorporated businesses. And then you have a limited liability company. So for said businesses, you would have an owner going to the Secretary of State to register the business as an LLC. And so it's the opposite to the first bucket, where you enjoy limited liability. So same scenario, somebody breaks their leg at your company, your office premises, they sue you with this limited liability. They are only assigned to the asset of the business. They can't go and have a claim on your personal assets. So that is the benefit or the protection you get when you form an LLC, a limited liability company. So that's the only difference between the second bucket compared to the first. The rest of the tax implications are the same if you form a sole proprietor and a partnership. So you have a pass-through filings, income flows to your personal tax returns, which we know, most of us know as your 1040 filing. And then you have self-employment tax, 15.3, distributions out of an LLC business is tax-free. Now, the third stage, which most small businesses may not end up being, because your C Corp normally are for medium to large companies, would be either your S Corp or your C Corp. So S Corp has 100 member limit. It also enjoys the limited liability designation I talked about. Now the S Corp compared to the C Corp, from a tax filing standpoint, the S Corp has that same pass-through designation, where the income of the S Corp flows to the individual owners. So the company itself doesn't pay tax on the income. Income flows to the individual owners. The flip side, for a C Corp, the company pays income tax. So I think it's around 21% for C Corp. So the difference between all the other entities and the C Corp is that none of the other entities pay income tax. What they pay is a self-employment tax, as I indicated. They don't pay income tax. The income flows to the individual partners. But for the C Corp does pay income tax. And so you pay tax on the business profit, which is 21%. What the S Corp pays is self-employment tax, similar to the other two buckets. But the benefit of the S Corp is that it is half of what the other pass-through companies pay. The other companies pay 15.3, S corp pays 7.65. So that right there is a good tax strategies for some small to medium-sized business owners. You save almost half of employment taxes on an S corp, and then dividend is tax-free on an S corp, but for a C corp, the shareholders will pay dividend tax on any dividend distributed. So this is just the broad, or maybe a summary of the business structures that we have in the US. Now, moving on to the next slide, what I wanted to call out here is the tax filing and then the deadlines. These are very essential to category. So anyone on the call who has a business will fall in one of the categories I explained above. And then this will be your tax filing responsibilities. So for a sole proprietor and a partnership and an S corp has what we call the pass-through filing, as I explained. So with those three categories, if you fall under each of those three, you have a pass-through filing. What it means is business itself doesn't pay income tax. The income flows to your personal returns, which is the Form 1040. So for an sole proprietor, which is the SP, you report your business income and expenses on a form called Schedule C on your personal tax returns, which is Form 1040. A partnership, however, would file a separate business form. So normally the Schedule C is part of the personal tax return form, which is Form 1040. That is a form for each and every individual who files taxes in the US. So if you're a sole proprietor, there is a form called Schedule C that is part of the 1040 personal tax return filing. But if you have a partnership, so if you have a business that you have more than one owner, you are required to file a separate business form called Form 1065. And it's specifically for partnerships. So two or more owners of a business. And then out of the Form 1065, you would derive a form that is called Schedule K1. It's basically is a form that shares the profit and losses of the partnership business among their partners. So if you have, if let's say a business have two owners and they share profit and loss 50%, if the business filed 1065 and have a profit of 10,000, the Schedule K1, each of the partners will have Schedule K1 that splits the profits 5,000 each. And then they will use that K1 as the supporting form to attach their personal tax returns. And so their 1040 filing will have Schedule K1 as part of it. So with a sole proprietor is Schedule C, but with a partnership is Schedule K1. But the difference is that you have to file a whole business return for the partnership. If you're an S corp, you also file a form that is Form 1120S. Same concept like the partnership, you will get a K1 that shows how profit and loss are split between the partners or the members, as they call it for S corp owners. And then they will use that K1 to file their personal tax returns, which is the Form 1040. So this is the breakout of the forms, and each one of us, if you're not a C corp, you every year, if you have a business running, you would have to file one of these forms. And then the filing deadlines is what has been called out for a sole proprietor, April 15th. That is if you're if you have a calendar year end as your business tax period, which means December 31st is your calendar year end, you have to file your taxes by April 15th. In fact, you have to file and pay any anticipated taxes by April 15th. Now, if you, maybe because of some people might expect delays in getting their tax document together, so you have the option to file for an extension using a form called 7004, file a 6-month extension. So once you file that form 7004, you have 6 months up to October 15th to file your tax returns. However, I want to stress that if you expect to owe the IRS, you need to pay those expected payments by April 15th. Most business owners are not aware that the extension is just for the filing, not for the payment. You are required to pay by April 15th. So estimate if you think you owe something, estimate the amount, pay by April 15th, but you can file by October 15th. Most people, so when they wait and when they determine the tax at the end, October 15th, they tend to pay additional penalties and fees because they didn't pay within the threshold by April 15th. The partnership has a deadline. Form 1065 has to be filed by March 15th. You can extend that to September 15th. Same for the S Corp as well. Then the second bucket is the C Corp. Again, these are for medium to large business owners. If you file for a C Corp, the form you need to file is 1140, and then the timing for filing is April 15th. You can extend to October 15th. These are very good information that most business owners are not aware of. So I believe, hopefully, this is very helpful to you. Now, moving on to our next key information for business owners, organizing business records. One thing I've noticed within my years of doing business owners, especially small to medium size, usually don't have the time and expertise to be able to keep proper books. Now, one of the number one IRS red flags is incomplete bookkeeping, incomplete records. So if you're here and you're a business owner, you have operated within somebody has a question. Okay. If you've operated within the year and you haven't kept proper records, that is a red flag. I've helped a client who got notices. He was audited, and when they came to do the audit, he didn't have proper records. So what the IRS did was to just go look at his bank statement and look at all the receipts and assume that was his income for the year, and then slapped interest and penalties on it. So I had to come in and then try to summarize and prepare a bookkeeping sort of for the client to be able to beat down that estimated taxes. So my advice to business owners and anybody here on the line, you have to keep proper records. So why do we keep records? For you to be able to monitor the progress of your business. If you don't keep records, it's difficult to know if you're making profits. It's even difficult to strategize because keeping proper records help you to know your revenues, your expenses, help you to even strategize if you are incurring costs that you can really cut down, right? Some of the benefits are for financial statements. One of my clients recently wanted to go for a loan, and I needed to quickly summarize his financials and get financial statement, his balance sheet, income statement, cash flows, so that he can support to apply for the loan, right? So there are good benefits to keeping good records, right? IRS comes in without, and you don't have any records. It's like you even make their work easy because they wouldn't spend too much time trying to ask questions. They just slap you, look at your proceeds, slap their rate on it, and then they keep moving. So it's essential for each business owner to keep proper records. Now, how do you keep proper records? I mean, some folks do Excel spreadsheets, which I think is very tedious and prone to a lot of errors. I recommend business owners having a bookkeeping system. There are QuickBooks out there, Gusto, Sage. I mean, QuickBooks, I think, is the #1 tool for small business owners. So if you are here, you don't have your QuickBooks set up, try to reach out to Tashi here, and we can help you do that. You need to properly keep books of accounts to support what you file on your tax returns. Because if your tax preparer comes, if I come in, you want me to file your tax returns, I need to see your bookkeeping. And one of the things that tax preparers are mandated to do is to do some due diligence on the records of their clients. So if I come, I've rejected some clients because I thought they were too risky to prepare their returns because they didn't have enough data to support the numbers they were provided. So it is key that every business owner here needs to have. It's not just having a bookkeeping system, having accurate bookkeeping. So another red flag is inaccurate financial reports. So you can have QuickBooks, but you can have wrong information inputted in QuickBooks and hence wrong or inaccurate outputs. So I know sometimes business owners, they want to do everything by themselves, but I would say it's good to we'll look at some of the mistakes that people make as we go to the slides. One of the biggest mistakes business owners make is not reaching out to professionals who have the experience and expertise to do some of the tax that are relevant to the business. So #1 is accounting and bookkeeping. #2 is taxes. You may have experience and expertise as a business owner in the field you're in. Maybe you are in home care. You have the experience to do that job, but you don't have the experience in taxes. It will be, but if you don't speak to the right professionals to do that work, you might pay for the consequences later on when IRS comes to do an audit. So I always say, get an experienced bookkeeper to do your bookkeeping. If you know how to do it, that is fine. But I would suggest as a business owner, because there are certain transactions that may not be expenses. I've met a client who, let me give an example, a restaurant client. Tips usually are not taxable to a restaurant business because tips that they got from customers were taxed on the payroll of employees. But as the year I audited that particular client, tips was part of his business income. So it means all the years that he was auditing, all the years that he was filing taxes, he was paying extra taxes on tips. And tips was also being charged as a payroll expense. So you need a professional to help you to churn out accurate bookkeeping so you don't pay too much taxes erroneously and pay less taxes erroneously. So I want to just hammer that point. And then finally, commingling of business and personal transactions. We'll see that later on, but this is also another key issue that business owners, part of not organizing their business appropriately, they tend to commingle. you will see personal business transaction flowing through your personal bank account. So if you are here and you do that, I want to advise you try and separate that. That is a big red flag for IRS. Try and separate. Get a bank account for a business. If you're using your personal credit card for business transactions, try and get a business bank account, a business debit card, and then keep the transactions separate. So these are very good points that we have to be mindful of. Now, let's
I have
have
a
some.
question.
Yes, sir.
Hey, Moses, Sean Hurdle here. How you doing?
Good.
I have a question for you. Based on the first slide you had with the structure. Hold on, I wrote it in the chat. Does distribution refer to a business owner paying themselves?
Yes, it does. So, yep, the cash you take out of the business is tax-free.
Okay, so my follow-up question is it typical for partnerships to pay income or distributions to them, like to themselves? So the partners, let's say there's 3 partners in a business, is it typical for them to pay themselves as 1099 independent contractors?
Okay, so this, okay, so I understand your question now. Now, this distribution I'm referring to is not 1099. So normally the 1099 is a form that is given to independent contractors. And I'll even raise that in one of my common mistakes that business owners do. So 1099 are independent contractors. So for example, if your business engage me to do maybe a tax work, I am not an employee of your business. I'm an independent contractor. So when you pay me, you can issue a 1099. You have to issue a 1099 if it's above $600. A partner to a business is not an independent contractor unless that partner acts or provides services and acts in the capacity of an independent contractor. So this distribution here is distribution to a partner in their capacity as a partner. So I hope you understand what I'm trying. I'm trying to draw a distinction between 1099 and a partner. Sometimes a partnership business can ask one of the partners to pay a specific tax for the partnership. And so they would agree that they will pay that partner in a capacity as an independent contractor who is paying or performing a specific service or tax. For that person can be issued a 1099 because he's performing an independent contractual work. But this distribution here is referring to the partners in the business agreeing to distribute profits to themselves, right? Maybe every quarter. And it goes to all the partners here. That is totally different from maybe one partner performing a specific work for the partnership. And as such, they are issued a 1099. I hope that's clear.
Yeah, that's very helpful because, so just last question on this, if the business partnership isn't making a profit, then there would be no distributions to give to the partners, right?
Correct. I mean, again, it depends on the agreements between the partners.
Right.
It depends on the agreement between the partners. So distributions are normally based on cash available, right? So there is a possibility where maybe, let's say, the first quarter of maybe next year, using that as an example, the business really hasn't made a profit, but there's cash available.
Yeah.
the partners can agree and say, though we've not made a profit, we all agree to take 5,000 each out of the business based on our share of profits or share of distributions, and they can go ahead, right? It's again, the distributions are dependent on the partnership agreement, what the partners
wow.
agree to.
Wow.
So it's possible. It's not
Yeah.
necessarily profit. So
Okay. That's why I want to work with you before I form my business.
yeah. Okay. No, good questions. Okay, so moving on. So what type of records would the business owner have to keep for purposes of tax filing? Gross receipts, purchases, expenses, travel, assets. So all these, if you have a good bookkeeping system like QuickBooks, you would be able to categorize transactions as they flow through your bank statements. So your gross receipts would be your revenues from your business, whatever business you are. If you're selling, revenue from sales, purchases, whatever you incurred to acquire to generate the revenue would be correctly categorized. Expenses, other expenses you incurred in a business. If there was travels, there were transportation, entertainment, meals, gifts, all those should be correctly categorized. And more importantly, assets. If you bought an asset is not an expense, especially if you buy an equipment that you can use more than a year. It has to be categorized as an asset because there are tax benefits associated with specific assets a business can buy. And then employment taxes as well, that your W-2s, your 1099s, all these are essential records that I know QuickBooks even does your 1099 filings for you and keep records as well. So yeah, if you are here and you need help, as I indicated, feel free to reach out to Tashi and team, and we can provide that help to you. Okay, so moving on to the third category is understanding deductions. Now, deductions are essential to every business. As I indicated earlier, one of my clients who didn't keep proper records, IRS came, looked at his gross receipt from the bank, didn't include any deductions, and just assess taxes and other penalties. So I had to come in and try to build out his deductions to be able to reduce the tax that was assessed by the IRS examiner. Now, deductions are essential because they help reduce your tax burden. They help reduce your tax exposure. And so what goes into deduction? So I have here that for you to be able to have a business deduction or a business expense, or for a transaction to qualify as a business expense, then it has to be ordinary and necessary for the business. So if you have a transaction that is not relevant and helpful for business you're in, then the IRS can disallow that. So you can, though you can charge it as a business expense in QuickBooks, if they come for an audit, they can disallow it. So business expense has to be relevant and it has to be necessary for the line of business you're in. And it has to be solely related. So you can't be in maybe your business is, you have a home care, and then we are buying stuff that relates to a manufacturing business and charging it as a business expense. It is not related to the type of business you are in. So a business expense or a deduction has to be solely related to the business, and then it has to be incurred by the business. Very important. You can't. So let's say if you have two separate businesses, you can't you can't book business A's expenses in business B, especially if they are not related. So it has to be incurred by the specific business. So these are like the three main criteria in charging a business deduction. IRS knows that most businesses would want to overstate their business expenses. So this section of your tax returns is very key when you are completing. Recently, I saw a client who got audited and IRS disallowed all her business expenses because to them it was a sham and charged excessive interest and penalties. So we have to be mindful of the type of businesses, especially first mindful of who files your tax returns for you. If you have a tax preparer who guarantees you refunds that you know you don't deserve, please be mindful. Or you know they are cooking up your business. And the IRS have tools and trend analysis that they can detect fraud. So let's be mindful of what we categorize as business expenses. Now, what are some of the type of business deductions? So if you start a business newly, your business startup costs, your business license, the fees you pay with the Secretary of State, they are all allowable business deductions. Depreciation. If you buy an asset that you use over a period of time, the IRS allows you to spread the costs of the asset over specific periods. So for example, if you buy an equipment that can be used for 5 years, you can depreciate, spread the cost over 5 years, and every year a portion of the cost reduces your taxable income and hence your tax at the end of the year. There's even an option for some specific assets where you can write off all the value in the first year, especially if you're going to make so much profit in that year. You can write off all the value of the assets and it will reduce your tax drastically. So depreciation is one of the business deductions. Business use of home. So if you work from your home, you're allowed to allocate some of your home expenses to your business. And that will help reduce your taxable income. Car expenses. If you're using your private car for business, so long as you track the mileage, and there are apps out there that helps us to track our mileage as a support for the use of a personal car for business related activities, you can basically allocate some of your car expenses to your business. And then there's qualified business income. That is a 20% deduction that IRS gives to most businesses. Not all, but most businesses. So it's just a 20% deduction that you enjoy that reduces your taxable income. And then all other expenses that are ordinary and necessary for your business. If you're able to justify that this business expense, this expense is needed for the business, it will qualify as a business deduction. So you name it, your rent, your business travels, if you do business, other business related expenses that you can think of, so far as it meets the criteria as a business deduction. Okay. So these are like pointers for us to know. Now let's look at some common mistakes that most of us do as business owners that I want to call out, and then we should start planning. Now, I talked about this earlier, commingling of personal and business expenses. Most of us maybe before foul. Somebody have a comment here? Okay. Most of us may fall foul of this first mistake, commingling of your transactions and even struggling to separate it. So I always advise my clients that try to separate your business from your personal. Don't be paying business stuff with personal credit card. If you do, try and keep the receipt for that and have it in QuickBooks. You can save receipts. and have those receipts saved in QuickBooks. But as much as possible, keep those two separate. Number two, I would not be surprised if up until now, some business owners have not really kept proper books as we are nearing the tax period. You don't know how much, you don't know your total revenue, you don't know your total costs to generate those revenue, you don't know your total expenses, you don't know the assets you have bought. Avoiding bookkeeping throughout the year is the biggest mistake a business owner can do. Because one, you might even have legitimate business expense that will help reduce your taxes that you may have forgotten because you didn't record it. So bookkeeping is key. Number two, with the third point, missing IRS and state filing deadlines. Some business, when you miss a deadline, the impact is that you pay interest and penalties. So most of us are paying huge amounts of interest because we missed the April 15 deadline for paying taxes. So as I said when I started, if you're filing your personal income tax by April 15th, and your tax documents will not be available, and so you seek for an extension to October, you still have to pay an estimated amount April 15th. The extension is just for the filing and not for the tax payment. Most people forget that, and then they wait till the October 15 deadline, and now they have to pay interest and penalties for not paying the tax by April 15. So missing filing deadlines leads to interest and fines. For sales, even for the state, your sales tax filings, they are normally due 20th of the next month. So October state sales tax filing for Minnesota is due in 2 days. Some business owners don't know that, especially if you are supposed to be paying sales tax. Your payroll filing, if you have a payroll system, they do the filing on your behalf, but you have to be aware of it. There's a payroll filing that businesses have to do, especially if you have a W-2. The fourth point, very, very important. Seeing people pay fines and penalties on the fourth point, misclassifying W-2 employees from 1099 employees. Some business owners deliberately don't want to pay taxes and hence don't want to file W-2. So they'll just file 1099 where they should rather be filing W-2. So this is a big issue that IRS always look out for. Now, there is a difference between a 1099 and an employee, an independent contractor and an employee. An employee is someone who you, as a business owner, have stipulated timing for them to work, maybe a location for them to work. You have a predetermined tax for them. So if you have a staff that mainly fall under these categories, they are a W-2 employee that you have to be filing W-2 for. As against an independent contractor that you don't control their time, you don't control the work they do, you just look at their outputs. Such people you have to file 1099 for. So business owners have to be mindful of not mixing the two. Some people deliberately file 1099 for employees where they have to be filing W-2. This is a big IRS area. So please, if you're doing that, I would advise you to stop. Do the right thing. If somebody is an independent contractor who you don't control the time, you don't require the person to show up, you don't set predetermined times for them to do their work, they are independent contractors. They are not your. Now, no tax planning and no estimated tax payment. Most of us, this is something we don't do at all. We don't plan for the year. And so at the end of the year, we have so much taxes to pay on our 1040. So if you plan very well, there are good tax strategies you can set. And as I started, one of them is filing as an S corp. You can be an LLC, but you can file a form to tell the IRS that, hey, treat me as an S corp, and you save 7.65% on your employment taxes. So if you plan very well, by the end of the year, you probably will pay less tax as compared to a huge tax burden you probably have if you don't plan. This, a lot of small business owners don't think about it. But if you tax plan, it helps you to save a lot on taxes. There are so many things you can do. Your 401ks, your IRAs are all good tax strategic planning that you can adopt. Estimated payment. Now, business owners also avoid this completely. Every business that makes profits every quarter has to pay an estimated tax payment so that at the end of the year, even if they owe, they will not owe to a limit that they have to pay interest and penalty for missing or owing too much. Let me put it that way. So if you are here and you are making a good amount of profit every quarter, you are supposed to estimate taxes on those profits and pay to the IRS. Because if you don't do that, and at the end of the year, you owe so much, it leads to interest and fines. Most of my clients don't normally do this. And so at the end of the year, they have interest and fines they are paying taxes on. But if you're able to plan and estimate those taxes and make those payments, you avoid all those fines and penalties. And those fines and penalties, they add up. They add up and they are a heavy toll on your cash flow.
Excuse me, Moses.
Yes.
So, like, what if there's a quarter or a couple quarters throughout the year where you don't do any business? Is there still a form that you have to fill out to send to the IRS explaining why you're not filing?
No. So if maybe for a quarter you have maybe zero profit, you don't have any revenue, and you don't have any, you have a loss, you don't have to pay any taxes. The idea of estimating every quarter is to prevent a huge tax burden at the end of the year and hence penalties. So if you don't have any profits, you don't have to pay. You don't have to file any form to tell the IRS, I don't have enough profit. So, but if you do, then you have to pay. You have to you have to pay the estimated tax payments. So you don't have to do anything. So within the year, if you know you don't expect to make huge profits within the whole year, it's fine. You don't have to. I was just working for one of my clients, and he made about 120,000 profit for 2024, and he's paying about 17,000 in taxes. And I know penalties will be added onto that. It was one of the things I had indicated to him that, hey, you're making so much profit, you got to pay something every quarter. But I think he failed to do that. So once you know you're going to make so much profit, and some of us, we know from, I mean, by Q1, and if you're keeping proper records, and again, it comes back to you having proper business records, you are making so much by Q1, Q2, Q3, and Q4. So then the expectation that profits should translate into cash, and then cash into tax payments. Okay, so the last two, under reporting of income and overstating of expenses, I've already talked about that. If you're working with a tax professional who is cooking up numbers, I remember a couple years ago, I learned some folks in some of the cities, some tax preparers were picked up, and they were rounded up and picked up by the police because of some of these things, under reporting of income and overstating expenses. You have to be mindful of that as a business owner. In fact, if you ask the tax preparer to file your tax returns, you are still responsible as a business owner. Show the blame to the tax preparer. You are still the ultimate responsible person for your tax returns. So we have to be very mindful of that. And then I also talked about trying to do it all by yourself. As a business owner, you cannot do everything by yourself. You need help. So if you need help, reach out. People is the bread and butter of some people, and they will be able to support you with actually doing the work and also providing you guidance. So please reach out to Tashi here and team, and we can help you. Now, the final slide for today is what's new this year. There's a lot of interesting stuff happening because of the OBBA that Trump signed into law this year. And so it's going to see some positive shifts in our outstanding tax positions at the end of 2025, or for this 2025 tax season. Because most of them, I mean, I would say a large portion of the OBB, when I say OBB, a beautiful bill, right? As we know it. It's tried to shift cash into, I would say mainly individuals who are below like the high end thresholds, right? So you're 500 grand and below. So it's like a pendulum, it's like a shift, right? From the high enders to those of us who are maybe small to medium ends. So the first notable, in fact, there's a lot of changes, right? But I wanted to just call out the notable ones. There's obviously an increase in our standard deduction from, I think it used to be 14,600 in 2024 for single. It is now 15,750. So that has gone up, which would also lead to, once standard deduction goes up, it leads to your taxes goes down. So yes, I'll try to highlight the impact here. So that is very, very impactful, at least for the married couples has also changed because of that change as well. Head of household has also changed. The next important thing here is SALT. Now, SALT here means states and local taxes. So there are two types of deduction each and every individual takes on their personal tax returns. We have the standard deduction, and then we have the itemized deduction. Itemized deduction, bunch of items, right? So the itemized, so you normally would take the greatest. So whatever is the greater, so between your standard deduction and your itemized, you pick the greater, and that will reduce your AGI, your adjusted gross income, to arrive at a taxable income, where your taxes will be assessed on. So if your itemized is greater than your standard, you choose the itemized. If the standard is greater than your itemized, you choose the standard deduction. Now, one of the items in the itemized deduction is state and local taxes. So, for example, for those with W-2, for W-2 employees that pay state income taxes, those state income taxes fall under the SALT, which is under the itemized deduction. It used to be limited to $10,000 within the whole year, but the OBB, the One Big Beautiful Bill Act, has increased the 10,000 limit to 40,000. So for some of you, if you are paying, if maybe in 2024 you pay more than $10,000 of state income taxes, your itemized deduction would have capped it at 10,000. But now with the increase from 10,000 to 40,000, it increases. You're able to, if you paid let's say 11,000 state income taxes to Minnesota, you can charge all the full 11,000 because the limit has been increased from 10,000 to 40,000. So that is what is new this year in the second item, interest on car loans deduction. This is entirely new. Any car loan, any new car that was bought in 2025, interest that has been paid is a temporary deduction. I think it's for 4 years, from 2025 to 2028. So if you buy a new car, the interest you pay within the year, you are allowed to deduct it. It's a new addition is a new additional deduction on your tax returns. So you're able to deduct um, up to 10,000. So let me just clarify that. Up to $10,000. That's the limit. And those who have more income, about 500,000, it begins to phase down. So if you buy a new car, you are allowed to deduct both individual and business. You are allowed to, if interest on a business car loan is already deductible, but this is specifically for individuals. So if you buy a new car this year, the interest you can have that as an additional deduction up to $10,000. No tips, no tax on tips and overtime. So tips and overtime, and I talked about tips earlier, normally would be, so tips from, let's say, a restaurant was added as a payroll item for employees to pay tax on those tips. But with this new bill or act, that is entirely scrapped off. In fact, it's up to 25,000 per taxpayer. So though the tips will still be taxed, so let me just qualify that. It will still be taxed in the payroll, but it will be allowed when you file your tax returns at the end of the year. That taxes you paid would be given back to you. So let me just qualify that. So nothing will change from a payroll standpoint. It will still be taxed through the payroll, but at the end of the year, when you file your returns, all the taxes you paid on those tips will be given back to you as a credit. So same for overtime. So once that's non-salaried workers who basically have overtime, all those taxes, though they'll be taxed, it will be given back to them up to a deduction of 12,500 per taxpayer. So overtime is up to 12,500, tips is up to 25,000 per taxpayer. Increased child tax credit. It used to be 2,000 in 2024 per child. It's now 2,200. That is the increase that the OBB brought. Trump accounts. So you can set up now an IRA account for your child. And it's between 2025 to December 2028. And you can open a $10,000. You can open an IRA account for your child, and you have a $10,000 tax credit. So you can decide to put 2,000 IRA accounts for your child, but you get 1,000 tax credits at the end of the year. And you can only withdraw those distributions after they turn 18. So that is what they call the Trump accounts. That is a new thing that has been introduced. And then the final thing here is 100% bonus depreciation. This particular item was being rolled off from the previous TCJA, Trump Cuts and Job Act. It was being rolled off. Now, what this means is that I talked about it. You can buy an asset in the first year, and depreciation just spreads the cost over a number of years. But the bonus depreciation allows you to write all the assets in the first year, rather than spread it over the number of years that the asset can be used. This particular bonus depreciation was being rolled off from the previous act, but the new OBB reinforced it. And so that is one of the items I think would impact business owners, especially if you're buying a car for your business, for example. And then Section 179 is also similar to this particular item. So overall, that is like a summary of what I wanted to touch on today. I want to pause over here if anyone had any specific questions, or if we have any questions in the chat. Yeah,
I got a question, Moses.
yes.
So right now I have my business registered as an LLC. When do you think would be a good time? What stage in my business would be a good time to switch it over to an S corp?
Okay, so I'll answer that question, but I will explain the switch. So the switch is not, it doesn't mean you are accessing, the switch is not converting the whole LLC into an S corp. You still stay as an LLC, but you just let IRS, you file a form to just say, hey, IRS, just for tax purposes, treat me as an S corp. I just wanted to establish that. So mostly some business owners think they are converting the whole business from an LLC to an S corp, but you still stay as an LLC. The form just notifies the IRS to treat you as an S corp, but you still stay as an LLC. Now back to your question. I'll say it depends. There are some, as you saw in the tax filing, there are some costs associated with filing as an S corp. The initial form to file to notify the IRS to see you as an S corp, normally you have to pay for that service, and then every year you have to pay a separate business return filing costs. However, I think if I always say cost benefit analysis, if you're going to make so much profit that the benefit, for example, of the 7.65 employment tax savings that you get is higher than the cost, I would say go for it. So if you expect to, let's say, make 100,000, let me even simplify it to, let's say you expect to make maybe $10,000 a year as your profit. And so with $10,000, you're probably going to save 7.65 of that as the employment tax, which comes to 765, right? Now 765 as the tax savings might be less than the costs to export. Maybe because typically the cost ranges from 1,005 to 2,000 in the first year and around 2,005 annually. So if that is the basis of your decision making, I would say any profit you make above that. So let's say if you make 30,000, which would be a cost savings of about 2,000 or even 3,000, then I think the numbers make sense. So I always tell my clients, do the math. Look at the cost to file as an S corp, and then the profit point on which you would start, which the benefit would exceed the cost. Then that should be a trigger to file. I don't know if that answers your question.
It does. Thank you.
Yeah. Yeah, I think I saw a question in the chat saying, "Are you going to cover non-profit taxes?" So I can touch on it briefly. So non-profits are not supposed to pay any taxes generally, as we know, unless they indulge in business dealings that is contrary to the non-profit charter. So if you are supposed to be a non like it's what disabled kids as an example, you have a non-profit that takes care of this, and now you are maybe doing something completely different and making profits, then the IRS can treat that, they call it UBA, unrelated business activity, as a taxable business venture. Notwithstanding, non-profits are not supposed to pay tax. They're supposed to file a form called Form 990, and there are different types. You have the ES, you have the Z, and it depends on the amount of proceeds the nonprofit made. So I would say this is a summary on that. If you want us to talk more to helping you file, yes, we can do it, but the focus on this was mainly on the for-profit taxes. Any other questions? Okay, so I believe this has been a helpful helpful informational resource for you guys. And as I indicated, Tashi and team and myself, we are here available to help as we draw close to the end of the year. If you have any bookkeeping needs, you want to get your records, business records put together, we can still do it. There's still time, so we can have some clean data for the tax filing for this particular season. So if there's no other questions, Tashi, I will yield to you or Tricia.
Yes, sorry, Tashi did have to run. I don't think there were any other questions in the chat, so I'm just gonna say thank you so much for your time, Moses. This was amazing. And like Tashi said in the beginning, this will be on our YouTube. But for those who would like Moses's information to reach out to him, please send your emails in the chat so that I can send you all that information.
Good.
Okay, thank you, Moses. Thank you, Trisha.
Yep, thank you.
Thank you,
Have a good one,
guys.
everyone.
Thank you.
Bye.
If you're watching on YouTube, thanks for watching.